Global Real Yield Index, How Real Yields Shape Capital Flows. Section 1, Introduction, the Governing Variable. In periods of economic uncertainty, investors often look to policy rates, money supply growth, or fiscal stimulus to understand the direction of markets. Yet these variables, taken in isolation, rarely explain capital movement with consistency. Nominal rates can rise while inflation rises faster. Money supply can expand without generating asset inflation. Fiscal deficits can grow without immediate market stress. The variable that reconciles these tensions is the real yield. Real yields, defined as nominal government bond yields minus inflation expectations, represent the true cost of capital after accounting for purchasing power. They determine whether capital is rewarded for remaining in safe sovereign instruments or incentivized to seek alternative stores of value and return. This exposition introduces the Global Real Yield Index, abbreviated as GRYI, a gross domestic product weighted composite of 10-year real sovereign yields across major economies. The purpose of GRYI is not merely descriptive. It functions as a macro regime indicator. When real yields remain meaningfully positive across large economies, global liquidity tends to remain anchored in fixed income. When real yields compress toward historically low thresholds, the probability of capital reallocation increases. The argument is straightforward. Real yields shape capital flows more consistently than nominal policy rates. Section 2, Foundations. Why real yields matter. A nominal 10-year government bond yield reflects the market's required compensation for lending over a decade. However, nominal yields alone do not indicate whether investors are gaining or losing purchasing power. The real yield adjusts for expected inflation. Real yield is equal to nominal yield minus inflation expectations. This simple subtraction produces a more meaningful signal. If nominal yields are 4% but inflation expectations are 3%, the real yield is only 1%. If inflation expectations rise to 4%, the real yield collapses to zero, even if nominal rates remain unchanged. Historically, sustained positive real yields correlate with stronger currency regimes. Anchored capital in sovereign bonds, contained asset inflation. Conversely, periods of compressed or negative real yields correlate with multiple expansion in equities. Commodity rallies, gold appreciation, increased appetite for alternative stores of value. In other words, real yields influence the opportunity cost of risk-taking. Section 3, Constructing the Global Real Yield Index. To move from a domestic framework to a global one, we aggregate real yields across major economies. The Global Real Yield Index consists of 10-year nominal sovereign bond yields, 10-year inflation expectations, also known as break-even rates or consensus projections, derived 10-year real yields. Each country's real yield is weighted by its share of global gross domestic product. This ensures that large economies exert proportionate influence on the index. Recent snapshot estimates for March 2026 United States, approximately 1.75% real yield. China, approximately 1.65%. United Kingdom, approximately 1.9%. Germany, approximately 0.7%. Japan, approximately 0.7%. India, approximately 2.2%. Brazil, approximately 9%, driven by risk premia. After weighting major developed and BRICS economies by gross domestic product, the Global Real Yield Index approximates 2.2%. This indicates that, on balance, the global system is operating within a positive real yield regime. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4, the regime framework. To interpret the Global Real Yield Index meaningfully, we define regime bands. Above 2%, tight or anchored regime. Between 1% and 2%, neutral or transitional regime. Below 1%, compression or reallocation risk. Below 0.5%, high probability of capital escape. At approximately 2.2%, the current Global Real Yield Index suggests that global liquidity remains structurally anchored. This helps explain why large money market balances, particularly in the United States, have not rapidly reallocated into risk assets. The opportunity cost of remaining in sovereign debt remains positive in real terms. Section 5, the capital escape threshold. The capital escape threshold can be defined formally. If global real yields fall below a critical level, referred to as theta, the probability of capital reallocation increases materially. Escape condition. Real yield is less than theta, where theta is approximately 0.75% to 1.0% for developed markets, higher for emerging markets due to structural risk premia. Below this range, real compensation becomes insufficient relative to historical norms. Investors begin searching for alternative return sources. Importantly, capital does not move randomly. It moves in response to collapsing opportunity cost. Section 6. Where capital moves. The destination of reallocated capital depends on the cause of real yield compression. If compression results from aggressive monetary easing, equities benefit from lower discount rates. Growth and duration-sensitive assets outperform. If compression results from inflation rising faster than nominal yields, commodities and gold attract flows. Real assets outperform financial assets. If compression occurs during systemic stress, liquidity preference initially dominates. Short-duration sovereigns and reserve currencies absorb flows. In all cases, the trigger is the same: declining real compensation. Section 7. Policy implications. Central banks rarely reference the global real yield index directly, but their behavior reflects sensitivity to real yields. A sustained collapse in real yields can trigger excessive asset inflation, distort capital allocation, encourage leverage and duration extension. Conversely, maintaining positive real yields helps anchor liquidity. This may explain why policymakers resist aggressive rate cuts when inflation expectations remain elevated. The objective is not simply to manage nominal growth, but to avoid crossing the real yield threshold that destabilizes capital distribution. Section 8. Conclusion. The anchor and the threshold. The Global Real Yield Index provides a structured lens for understanding macro regimes. It synthesizes disparate sovereign yield data into a single signal that reflects whether capital is likely to remain anchored or reallocate. At present levels, global real yields remain comfortably positive. The system is not in a compression regime. However, should the global real yield index approach the 1% threshold, the probability of capital rotation would increase. That shift would not represent a policy anomaly or market irrationality. It would reflect a structural response to diminishing real compensation. Real yields are not merely a derivative metric. They are the governing constraint beneath global capital flows.